So, good morning, one and all present here. My name is Amit Kumar Singh, and welcome to yet another sessions on derivative. So, guys, if I talk about, I have taken till now 8 sessions, and if I talk about this subject called risk management and derivative, so what we have done till now, so we have started discussing about risk analysis on capital budgeting, and in that risk analysis on capital budgeting, we have discussed the application of coefficient of variation, standard deviation, expected return in the term of probability. We talked about certainty equivalent. We talked about risk adjusted discount rate. We talked about sensitivity analysis. We talked about scenario analysis. We talked about decision tree, and then these all we have done in risk analysis on capital budgeting. So risk analysis on capital budgeting was more or less analyzing the kind of risk what you can have whenever you talk about capital budgeting decisions. Capital budgeting decisions can be analyzed by using NPV, IIR, ARR, or payback, or discounted payback, or MIRR. But these tools of capital budgetings, they may or may not work under the condition of capital rationing. They may have give you contradictory answer whenever they are mutually exclusive projects. Like whenever you have to choose two projects, one project have more NPV and other project has more IRR. So which project would you choose? So how to solve such kind of problem? Then imagine if you are getting multiple IRR values. So then which IRR value can you consider for as a discount rate for analyzing a capital budgeting decision? So all these problems you may face whenever you are analyzing a capital budgeting decisions, and all these problems can be easily solved which by using much more better sophisticated tool of analyzation, probably out of NPV and IRR. We should prefer NPV over IRR by applying incremental cash flow method. And when you get multiple IRR values, that happens because whenever there's a chance of happening and cash outflow within the life of the project, and then you should prefer MIRR, modified internal rate of return, in place of IRR. So that way, I just give you few cases. So that way, somehow you can develop much more complicated tool for analysis of capital budgeting decision, and it help you to get a much more predictable or generalized answer whenever you are analyzing a capital budgeting decision. Gradually, when we go ahead and we try to talk about a capital budgeting decision, so it's not like the returns, the cash flows what we are talking about in capital budgeting decision, because capital budgeting decision it totally works on demand and revenue forecasting. So whenever you talk about demand and revenue forecasting, so how much can you certain about the future cash flows what you are expecting to generate? So that itself is a questionable mark, concern for any analyzer or anyone who is looking to invest in such kind of project. So when you talk about the cash flows, when you are within the life of the project, when you are trying to analyze the cash flow, it is very important to justify the data. And how you can justify the data by using percentage of revenue method, or maybe other demand forecasting methods in Excel or R or any other tool, whatever you're using. So that justification should be given, while the cash flows can be even or the cash flows can be uneven also. That's why we have much more sophisticated tool in Excel like XNPV or XIR. So if you use XNPV or XIR, so if you use XNPV or XIR, so they basically they gives you the NPV and IRR value at certain scenarios where in reality you have uncertain cash flows. So you need to give a date, you need to mention the date, and then you need to mention the cash outflows and inflows and outflows together along with the discounting rate. So that way it help you to get the NPV and IRR of a project. So basically, whenever we are analyzing a project, although NPV and IRR is much more is one of the tool which everyone look into whenever they talk about analysis of a capital budgeting. But whenever we see NPV or whenever we see IRR of a project, and we need to also understand how sensitive is that data with respect to the change of individual particular values, so that you can perform sensitivity analysis. And then if you really want to see like in different scenarios how your NPV will react, so for that you can do a scenario analysis. So that way when we work on tools like sensitivity analysis, or when we work on scenario analysis, ultimately what it basically help us to do, it basically help us to get more understanding about how the project will react under certain situations. Now the we instead of getting a single NPV value, we can talk about a multiple NPV values under multiple scenarios. And once we have a multiple NPV value with multiple scenarios, what we can do, we can talk about expected NPV, we can talk about an expected NPV. And when we talk about expected NPV, so that expected NPV is the summation of individual probability into the individual NPV. So once you get that, so you can find the standard deviation also for this. So the standard deviation for this is nothing but, so that is summation of, that is the summation of pi into individual NPV minus their expected NPV, the expected NPV. Okay, so minus expected NPV square. So that way you can find the standard deviation. And if you want to see the movement, if you want to do more risk analysis, you can calculate their coefficient of variation. So where the coefficient of variation would be standard deviation by the expected NPV into 100. It's just a tool. And risk analysis of capital budgeting, what we basically do, we go much more deeper, and we may also multiply each time when you get an NPV value. What you can do, you can multiply and factor, which talks about which talks about the certainty of that NPV. And that way you are talking about a tool called certainty equivalent. And gradually you can either do adjustment on the certainty of your values in the term of cash flows, or in the term of or NPV, or you may do adjustment on your discount rate, and that what is called as risk adjusted discount rate. So yeah, I believe you still remember what all we had done on the risk analysis on capital budgeting. And whenever you have more and more if and but conditions, whenever you are analyzing a capital budgeting, you can analyze the same thing by working under the decision tree. And in decision tree we may create multiple scenarios, and under multiple scenarios what we try to do, we try to analyze in capital budgeting decisions. So these all we had done in the risk analysis on capital budgeting. And gradually we have started discussing about derivatives. So when I talk about derivatives are basically financial instruments. So derivatives are basically financial instruments where we talk about a transaction which we'll do in the future based upon the present determined condition. So that is basically derivatives. So no one knows the history of derivatives since when the people started using derivative as a medium for transaction. But probably whenever a buyer or whenever a seller can have a concern about their price risk, and in order to minimize their concern over their price risk, so the kind of formal agreement where a likely buyer or a likely seller can do, where they talk about a transaction which they will do in the future based upon the present determined condition, that is what we called as a derivative. So initially, a derivative was developed as a risk minimization tool, and this strategy was called as hedging. The strategy was called as hedging. So initially, derivative was developed as a risk minimization tool, and the players who used to involve those were called as a long hedgers and short hedgers. So long hedgers were those players who used to take long positions in the derivative contract, and short hedgers were those people who used to take short positions on derivative contract. Long position basically means if you are likely buyer, if you're likely buyer on a derivative contract, then you're said to be called as long position holder. If you're likely seller on a derivative contract, then you are called as short position holder. So in the case of derivative, the long and short, they used to come together and they talk about a transaction which they will do in the future, and where the terms like exercise price is the price at which they will do in transaction in the future. The underlying asset quantity, the quality, the delivery date, everything is being pre-decided. And this form of derivative instrument, which was more or less informal, which was more or less it was bilateral. So this was called as OTC based derivative instrument. OTC basically means over the counter. So over the counter based derivative instrument, and this was called as forward contract. So forward contract is the earliest known derivative instrument. So where when we talk about forward contract, basically derivative. When we try to understand derivative, we are actually understanding derivative under the concept of forward contract only. So you can get more information. Try to get more information about forward contract. So forward contract, or try to get information about forward rate agreement. What is forward contract? What is forward rate agreement? What is forward rate agreement? Or what is swap? Try to get more information about these instruments. Swap can be of three types, not three type, two type. Swap can be interest rate swap. What is swap? So swap can be interest rate swap. So in IFM, you have a problem on swap. So swap can be interest rate swap, or it can be currency swap. So when we talk about swap, so there are a lot of types of swap. So very common. I'm talking about the very common. So the swap, one of kind of swap is credit default swap. So that was the reason for 2008 US subprime crisis. So many people give credit. No, credit is not the good word. I mean, this of 2008 US subprime crisis to credit default swap (CDS). Okay, so in India also, the RBI was not very interested to introduce CDS on the Indian financial market. So you can, if you type in Google also, so what is a concern? If you type in Google, a concern of RBI, concern of RBI on the introduction of CDS, CDS in Indian financial market, in Indian financial market, because swap was credit default swap was the reason for the US 2008 financial subprime crisis. So you can understand what would be scenario where if the same CDS can be implemented on the Indian market, then what can be the likely concern the RBI would be thinking about. So you can read about these articles to understand CDS. So I just give you one example. So you can see RBI warms up to the CDS, so credit default swap in the Indian financial market. So you can read about them whenever you get time. So what CDS is all about. So when if they're implemented in the Indian market, then what will happen? So you can read like role of CDS in the financial crisis, the role of CDS in the post financial crisis, regulation India has placed on CDS. So I just giving you an idea that because India has to adopt the financial market like CDS in the Indian market. So what kind of likely outcome the CDS can have on the Indian financial market? So CDS is basically it is a credit derivative instrument. So you try to get more information about CDS. You'll understand more about the 2008 US subprime crisis. So when we talk about CDS, so like in swap you have very instruments. In swap or FRA, more or less are similar terms. So you'll understand much more about them. Like CDS, if you want, you can learn about MBS or you can learn about ABS. So MBA stand for mortgage backed security, ABS stand for asset backed securities. So these are basically credit derivative instruments. Try to learn about them. 1 minute. So they are basically credit derivative instrument. So CDS or ABS or MBS. So these are basically credit derivative instruments. So they are the reason for the US 2007-8 subprime extra leverage crisis, credit default swap, mortgage-backed securities, asset-backed securities, CDO, collateralized debt obligation. So read about them. What is CDO? You can read about them, and you'll understand a lot about the financial market. So if you read about them, the role of CDO on US financial crisis. So you can see this. See this. How do CDO and CDS influence the crisis of 2008? So you read about this. So you'll get too much information about these instruments, and you'll understand US 2008 crisis. Read about Sarbanes-Oxley Act. Read about Sarbanes-Oxley Act. What is Sarbanes-Oxley Act and how Sarbanes-Oxley Act created 2008 crisis? Read about that. Graham-Dodd-Wiley Act. So all this, if you understand, if you read more, you'll understand 2008 crisis in much more better way. So it's important for the student of finance to know these things, because tomorrow wherever you go for interviews, they will ask you questions based on this. So if you say that you did risk management, so they will ask you the terms which is very common and which is being used in the real market. So what for studying for exam point of view, that will not serve the objective when you go for interview. Fine. So basically, when we talk about derivatives, so in derivatives, we are talking about a transaction which we'll do in the future based upon the present determined condition. And basically, when we talk about derivatives can be discussed on the name of forward contract, where forward contract is it is a OTC based instrument. But the problem with the forward contract was the forward contract contains the problem of default risk. Forward contract were illiquid instrument. So basically, so that concern of default risk, what you have in the case of forward contract, where if there would be too much volatility in the price of underlying asset, there is a scenario that one person may run away from the agreement, because forward contract is a informal agreement between the two parties, where the situation is as such that one person will never run away from the agreement. And in case if one person will run away from the agreement, then there would be a likely scenario of default. So forward contract contains the problem of default risk. So this problem of default risk, this problem of forward contract having the problem of default risk, that was minimized when we introduced a future contract. So when we introduced future contract, so that concern of default risk was gradually minimized, because when we talk about future contract is basically it is a standardized future contract. Is basically it is a standardized forward contract. It is basically a standardized forward contract. It is basically standardized forward contract on exchange. So when you talk about future contract, so future contract is future contract is the forward contract logic which we are trying to put on the exchange, and here exchange guarantees the default risk. So whenever you talk about a future contract, so whenever a long position holder, so in the case of future contract, so whenever a long position holder, so whenever a long position holder and a short position holder, whenever a long position holder and a short position holder, whenever they come to get into the future contract, so both the persons has to deposit and money with the exchange. So the money what they'll deposit with the exchange is called as initial margin. So both this person has to create an account. Both this person has to create an account with the exchange, with the broker. Exchange means broker. So where both the party has to deposit some amount as a collateral, that is called as initial margin account. So the reason of taking this initial margin, the reason of taking this initial margin is to make sure that they should not default on their agreement. So both the persons, either they are long position holder or either they are short position holder, so both this person has to deposit an amount with the exchange. Whenever the contract start, both the person has to deposit an amount, and that amount is basically decided depending upon the volatility of the underlying assets. So in order to calculate the volatility of the underlying asset, so basically volatility can be of two type. It can be historical volatility or it can be implied volatility. So here we basically calculate the implied volatility of the underlying asset, and that is basically calculated by a software called Prism. So Prism basically works on AI, and it has a platform called Span, which basically means Standard Portfolio Analysis of Risk. And what Span basically do? Span basically create 16 scenarios, and under each scenarios it calculate the war. War basically means the maximum loss what you can get on your portfolio on a given time period at certain confidence interval. And by working on the war, it's likely to create the expected war based upon these scenarios, and then that expected war what you get. So that expected war more or less calculates and tells you the what is the maximum loss what you can get on this given value of the contract. So that much is being calculated as an initial margin, and both long and short position holder, whenever the future contract starts, they have to deposit an amount with the exchange, and that amount is called as the initial margin account, which they have to maintain with the exchange. So this initial margin account with both the long and short position holder maintain with the exchange does not keep this money idle with themselves. Instead of keeping that money idle with themselves, the exchange plays the game of mark to market settlement. And by using this mark to market settlement, by using mark to market settlement, what exchange basically do? Exchange basically believes that as if today is the settlement date of the contract which was being agreed upon, and yesterday was the date when that contract is being started. So on based upon that, what exchange do? Exchange basically determine the value of profit and loss either long or short position holder can get if today is the settlement date and yesterday was the contract date and date. So based upon that, every day the exchange determines the amount which can be debited from one person account and credited into other person account. So this debiting and crediting process, it happens every day at the end of the trading cycle. And that way what exchange basically try to do, exchange basically try to understand what can be the likely impact of the change of underlying asset price on the value of the contract. Because whenever we talk about a derivative agreement, whenever we are talking about derivative agreement, we are talking about a transaction which will do in the future. So that is not happening right now. So there's a price which is being determined, which is called the exercise price. The number of contract which is being determined, and then based upon that value of contract, or the value of the future agreement is being decided, and that transaction used to happen in the future. So that creates an opportunity for leverage for both the long and short position holder. So at the same time, when this opportunity of leverage is being created, how exchange makes sure that opportunity of leverage should be properly informed to the investors and analyzing the risk management strategies. So that way, by working on M2M settlement, exchange every day tells you that what is happening to your underlying asset price, and any day if any of the person account touches something called maintenance margin. So maintenance margin is the threshold margin which in any case any of the person has to maintain. In any case, if the person at any of the person account touches the maintenance margin, then they have to refill the account back to the initial margin. So the difference between the initial margin and the maintenance margin is called as a variation margin, which they need to refill it back. If they will not refill it back, then probably the agreement will not work, and that moment only the contract will cease off. If the contract will cease off, then the other person would get difference of that variation margin as a profit of the other person, while the first person would lose the difference, which was the variation margin, as the loss. So that way the possibility of default never happened, because whenever you talk about future contract, exchange is saying that they are the counterparty for every person. So for long position holder, exchange is the short position holder. For short position holder, exchange is the long position holder. Exchange is saying that I will maintain the default risk, so I'll make sure the default does not happen. So how exchange do that work? So basically the logic how exchange basically do, so by working on the concept of M2M settlement, so exchange makes sure that the default never happens, and that ways the guarantees what the exchange is basically taking as a counterparty risk holder, that is being justified. So when you talk about future contract is nothing but it is a forward contract which is being implied over the exchange. Okay, so when you talk about future contract in India, index futures were introduced first of all for trading purpose. So index future was first of all was introduced. So basically we have a future agreement. We have options also. So futures and options are FNO segment. We call them FNO segment for trading purpose. So if you go to NSE website and you search derivative instruments, so you'll get FNO segment, future segments to trade over the derivative agreement. So whenever you talk about futures and options, when you talk about futures and options, they are basically trading over the exchange, and when they are trading over the exchange, their terms, everything is being decided by the exchange. So if you talk about if you talk about financial derivative instruments, if you talk about commodity derivative instruments, we have 1 month contract, we have 2 month contract, we have 3 month contract. We don't have 4 month contract. We don't have 5 month contract. We have only 1 month contract, or 2 month contract, or 3 month contract. And all the financial derivative instruments which are there in the form of 1 month, 2 month, and 3 month, they expire on the last Thursday of every month. When you talk about financial derivative, when you talk about commodity derivative, they expires on the 20th of every month. So everything is being specified by the exchange, and when you're trading on them, you need to follow the terms what is being specified by the exchange. So they are not customized depending upon your requirement. If you look for customization, then you have to go to OTC market, and individuals are not allowed to trade in OTC market. So that flexibility you don't have, at least in India. Maybe in other country you may have that flexibility, but in India you don't have that flexibility. So okay, so in India, if you want to trade on derivative, you need to go trade on futures, and you need to trade on options only. So gradually you'll understand more about futures and options. Okay, fine. So till now I'm only talking about future contract. Anyone have any doubt? Anyone want to ask anything? Any question, guys? Anything you want to ask? So tell me how much you'll get the A value. So this is 25. I can write as 100 by 4. 25 I can write as 100 by 4. So 250 I can write 1000 by 4. Three zeros I can cancel. 1, 2, 8, 2, 2. Three zeros I cancel. So the value of A you get is 2020 into 4. Achha, 200. Sorry, not 250. It is 200. This is 200, not 250. This is 200. This is 2030, then 200. I can cancel the zeros. So the value of A, so the value of A you will get is 20200 divided by 2. That is 10100. So this was the exercise price. This was your exercise price 10,100. Okay, so here they are given the initial margin also. So you have to understand this initial margin you'll give you because you know that because you want to maintain a collateral with the exchange. So that's why you give that initial margin. But for the end profit and loss calculation, initial margin does not play any role. I hope you understand this. So then so the day on 15 January when you have taken the Nifty future contract, that day the Nifty was trading at 10,100. So that day the Nifty was trading at 10,100. So you have taken what you have taken long position. So you have taken short position. So you have taken short position on April Nifty contract. You have taken short position on April Nifty contract. You have taken short position on April Nifty contract at 10,100. Okay, so you can see sold. So sold means short position. So the reason why you take short position. So the reason for taking short position is that you are believing that the Nifty will fall down in the future. The more the Nifty will fall down in the future, more the profit you'll make in the future. So I can express that with a diagram that is called payoff diagram. So 10,100. So if you take short position, so this is your payoff diagram. Okay. So above this line is your profit and below this line is your loss. So this is the payoff diagram. This is called as payoff diagram. So for long position holder, your payoff diagram is like this. Okay, so 10,100, so 10,200, 10,300. So more the Nifty will increase, the long position holder will get profit, and more the Nifty will decrease, and more the Nifty will decrease, more the Nifty will decrease, more the Nifty will decrease, the long position holder will get loss. So above this line is your profit, and below this line is your loss. So this is called payoff diagram. So this is called payoff diagram. So you can see this payoff diagram for the short position holder, the person who took the short position holder. This is the payoff diagram for him. So if Nifty will go beyond 10,100, then this person who has taken short position at 10,100 will get loss. And if the Nifty go below 10,100, if this Nifty will go below 10,000, if 100, if it go less than that, if it go less than that, so then if Nifty will go below it, then this person will make profit. So more the Nifty will go below 10,100, this person will get more profit. And if it Nifty go above 10,100, this person will get loss. So whenever whenever we talk about forward contract, and when we talk about future contract, the payoff diagram, this is called payoff diagram, is always linear payoff diagram. So remember, in case of future contract, in case of future contract or forward contract, in case of future contract or forward contract, in case of future contract or forward contract, the payoff diagram, in case of future contract or forward contract, the payoff diagram is linear. The payoff diagram is linear. Linear means straight line. Okay, so there is a possibility of there is a possibility of there is a possibility of unlimited profit. There's a possibility of unlimited profit and unlimited loss. So there's a possibility of unlimited profit or unlimited loss. Okay, so the person who take a long position or short position in the case of future contract or in the case of forward contract, so for them the payoff diagram is linear, that that there's a possibility that they may get infinite profit and infinite losses. Okay, so that's why this is the payoff diagram. So this is what similarity also in the case of future and forward contract, because in both future and forward contract you are obliged to follow the contract in the future. Because you are obliged to follow the contract in the future, There is a possibility of unlimited profit and unlimited loss. So here you can see this person A, he sold April Nifty contract at 10,100, believing that the Nifty would go below 10,100. So now you can see, on July 25th, the Nifty was closed. So on July 25th, the Nifty was closed on 10,800. Now you can understand, this person has taken April Nifty contract. Okay, this person, because maximum you can take a 3 month contract. So if you're in January, if you are on January and you want to trade on index future, so you can take February index future, or you can take March and index future, or you can take April index future. Okay, you cannot take May index future. So this person has taken April index future at 10,100. Then probably on the last Thursday of April, in the year, whatever the year was there. So on that year, on the last Thursday of April of that year, that contract will automatically will get expired, depending upon that last Thursday. Whatever is the exercise price, whatever is the future price of Nifty on that day, and based, if you compare that with the day when you went into the contract, what price you have taken. So comparing them, you can decide this A profit and loss. Okay, but here you cannot take July contract or on January. Okay, so from, if you are looking for July, then from January you have to take April contract, and before the expiry of April contract, you can take counter contract. Maybe in April you can take May, June, July. So again on April you can take another 3 month contract. Okay, so January contract you are taken for April, and then April contract. So if you are taking short position, no. So before the expiry, on the last Thursday of April, what you'll do, you'll take long position. So you can take long position on that day. So that way it gets square off, and then on April you can take July contract. So this is called rolling the hedge forward. This term is called rolling the hedge forward. So maybe this person was concerned about July. This person was concerned about July volatility on Nifty, but he cannot take July contract. So he has taken first the April contract, and then he rolled the hedge forward to the July. Okay, so now in July, I'm assuming that things remain the same because we don't have any data for April to July contract. So we assume they more or less remain same. So on July, the index closed at 10,850. So you understand this person has taken at 10,100. No, he shorted at 10,100. So he believed that the Nifty will go below 10,100. But if Nifty, any movement, if Nifty will go above 10,100, then this person will get a loss. Are you getting it? This person will get a loss. So what is the loss on that? So what is the loss? So the loss of A, the loss of A is basically 10,800, because that is that exercise price on that July, last Thursday of that July. So 10,800 minus 10,100. So this is the loss for that person into, he has taken one contract, no? So one contract, and one contract means 200 Nifty. So this is the loss for this person. So 10,100. Okay, sorry, 10,850, not 800. So 10,850. This is 10,850. This is 10,850. So 10,850. So this is 750 into 200. So 75 to is 150. Okay, then how many zero? Three zeros. This is the loss for this person. This is the loss of A. This much money the A has to deposit to the exchange. So you need to understand, guys, one thing, that whenever we talk about financial derivative instrument, you need to understand one thing, guys. Whenever we talk about financial derivative instrument, I'm talking about in India, so they are basically cash settled. So when you talk about financial derivative instrument, So their cash settlement happens. In the Indian financial derivative instrument, the cash settlement happens. So that cash settlement happens in rupees. So this person A has taken short position at 10,100, believing that the Nifty will go below 10,100, but instead of Nifty going below 10,100, Nifty has actually went up to 10,850. So because the Nifty has actually went to 10,850, so this person got a loss, and that loss you can calculate. And this is finally the final settlement happens. That is basically cash settlement. Okay, that is what we do in India. All this settlement, whatever we do, so they follow T plus one settlement. So basically they follow T plus one settlement. So whenever we talk about settlement in derivatives or in cash market, so in cash market settlement, they are basically a T plus two settlement. In derivative, we follow T plus one settlement. So the T is the date on which the final things happen. So that is the trading date. So and finally, when you talk about clearing and settlement, so if you talk about clearing and settlement, if you talk about clearing and final payment and everything, that happens on the next day only. So when you talk about the Indian derivative market, so basically the whole process, if you go to NSE and if you go to BSE, and if you when you start actually doing trading, so the whole process divided in three parts. One is trading, the second one is the clearing, and third part is settlement. So for the cash market settlement, we follow T plus two settlement, while for derivative it happens T plus one settlement. So the when's the day when the final bookkeeping work happens, next day only you will get the money. Either debiting or crediting of that money happens in your account. Okay. Anyone have any doubt? Any doubt? Anyone? So you understood this? Similar to this question number 5, you have question also in other year also. You can see the same question. What came in 2019, the same question came in 2018 also. You can see this. A's question number 5. A sold January future contract for 21,500, 21,000, 21 lakh 50,000, and for this he has paid an initial margin of 2 lakh 15,000. Each Nifty contract is a delivery of 200 Nifties. So you can determine the exercise price. So the day when he went for the contract, what was the exercise price? He took short position. So that also you can keep in your mind. So if you divide by 200, so you'll get 1075. So 10750, 10,750. So he had taken a short position at 10,750, and one contract means a 200 Nifty, and on the settlement date the Nifty became 10,850. So means he get a loss of 10,850 minus 10,750, 100 into 200. So 100 into 200 means 20,000 rupees loss this person has actually got. So question number 5, this has came already in the exam. You can see that. Fine. Any doubt, anyone? Okay. Now you can see this question number 5. Now you can see this question number 5. So an investor buys 500 shares. An investor buys 500 shares of SB Limited at 210 rupees per share in the cash market. Okay, so in the cash market, and then he hedge. So this is the process of hedging you are understanding. So in the spot market, this person has actually bought SB Limited. That is the what you say is the stock name. That is the stock name. So that was SB Limited, and then what was the price? He has taken at 210 rupees per share. He has taken at 200 rupees per share, and the number it was 500. So he had bought. So then this is 210 into 500. So this is 21 fives are 21 fives is 105. 21 fives is 105. So 105, then three zeros, 1,05,000. So this is what he had done. Now then, in order to hedge his risk, he has sold, he has taken short position. So short position, he has taken short position on 300 future, on 300 future at 195 rupees per share. Okay, so he has taken 195 rupees per share of AS Limited. So of AS Limited. So this he has done in future market. So the reason of doing this is to hedge his risk. The reason of doing this is why he's doing this, because he want to hedge his risk. So normally when you talk about spot market, spot market, you buy, and then in order to minimize your risk, that risk of downturn, because you bought at 210 rupees. Now if the price of SB Limited, if it go beyond 210 rupees, then no problem, more it go, more money you make. But in case if if the SB price decrease below 210 rupees, then what will happen? So if the SB price decreases below 210 rupees, more it go below 210 rupees, so more losses you will start making. So you understand this. So this person, so 210 rupees, he had bought the stock. So if this 210 rupees, this person has bought the stock. So this is the payoff diagram of the person. So more it go above 210 rupees, more profit he'll make. And if it start going below 210 rupees, then he'll start getting losses. So what this person did in order to minimize his risk over the SB Limited, what he did, he chose another stock. Maybe SB Limited is not trading in derivative market. Maybe that is the reason why he has not taken the short position on SB Limited. Otherwise, he would have taken the short position on SB Limited in the derivative market, but he has not taken short position on SB Limited. He has taken short position on AS Limited at 195 rupees. So he has taken short position on AS Limited at 195 rupees. So at 195 rupees, he has taken short position. So if so he has taken short position on 195 rupees of AS Limited. So if AS Limited go above 195 rupees, then this person will get loss in the derivative market. But if AS Limited go below 195 rupees, then this person will get profit from the AS Limited. Understand one thing, that for this investor, what this investor done, he has done hedging. This person has done hedging. So in future, if the price in future, if the price is above 210 rupees, okay, so from cash market, he'll get profit, but from the derivative market, he'll get loss. You understanding? So from derivative market, he'll get a loss. While if the price is below 195 rupees, then from the cash market, he'll get loss. But from the derivative market, he get a profit. I hope you're understanding. You're understanding. So while if the price is between 195 to 210 rupees, so he'll get loss in both the market. So the reason here, you need to understand this thing. So you need to understand this thing, that what actually happens in the market and how you can take positions in the market. You need to understand that part. So hedging, what is hedging? Whenever you apply hedging, so you are not actually looking for unlimited profit, and you are not actually looking for unlimited losses. The reason, you need to understand that the reason, whenever you do hedging, the reason is that you want to minimize your losses. You want to minimize your downside problem. If the price go above 210 rupees, more it go above 210 rupees, you will get profit from the stock, like the 210 you have bought. So more it go above 210 rupees, so you'll build up in making profits. But because of short position of AS Limited, what you have taken at 195 rupees, you will get losses. But even then, if you calculate your overall profit and loss, you get a profit amount, because you understand, no? So that way you can calculate, that way you can calculate your profit. But when you talk about the scenario, if it go below 195 rupees, so instead of simply getting unlimited loss, because if it go below 195 rupees, so if imagine if you're not taken the derivative contract, you would have been getting losses. But because you had taken short position at 195, so from that short position you get profit from that end. While the loss what you're getting at 210, that will get minimized because of that. So I hope you're understanding this part. It's just an example. So it's just an example. So with this you can calculate your net payoff diagram. If you want, you can calculate. If you want, you can take a situation of the like what can be the price in the future. If the price become 200 or 210 or 220 or 230 or 250, like this, or you can take 190 or 170 or 160, then you can calculate profit and loss on spot market. You can calculate the profit and loss on the spot market. You can calculate profit or loss from short position, and then you can calculate your net profit or loss. So net profit or loss. Okay, and then you can draw a payoff diagram based on that. So if it become 200 rupees, if it become 200 rupees, so you get a loss of 10 rupees from the spot market, and then you have shorted at 195, so you get a loss of 5 rupees from the derivative market. So the overall you get 15 rupees loss. Then 210 rupees, so 200 to 210 only you have keep long position, so this is zero. While here 195, you shorted at 195, you shorted at 190. Better let me write 210 and here 195. So you shorted 195, so you got a loss of 15 rupees here. So overall you get a loss of 15 rupees here. Then 220 rupees, you get 10 rupees profit. Here you get 25 rupees loss. So overall your loss is 15 rupees. 230 rupees, so you get 20 rupees profit. Here you get 35 rupees loss. So overall you get 15 rupees loss. 250 rupees, you get 40 rupees profit. And 250 rupees, 50, then 55, you got a loss of 55 rupees. Overall your loss is minus 15 rupees. 190 rupees, 190 rupees means you get a loss of 20 rupees, and 195 you have shorted, so you get a profit of 5 rupees. Overall your loss is 15 rupees. 170 rupees, you get a loss of how much? 40 rupees, na 30 40 rupees, while you shorted at 195, so you got a profit of 25 rupees. So overall your loss is 15 rupees. So I hope you understand. So here what you did, by taking long and short position all together, what you did, you created a possibility. You created a possibility where in every scenario you're getting a loss of 15 rupees. So it's just an this is just a strategy what is being mentioned. So we what we do. So this is the final payoff diagram, that overall you're getting a loss of 15 rupees. This is just an example why this person do like this. I have no reason for that part. Okay. So whatever he has done, what is given in the problem, I'm giving you the answer based upon that. So you understand. Now, next thing, one more thing you can remember, that in the spot market you can buy, and in derivative market you hedge your risk by taking short position. That is a common strategy. That is the common strategy. So common strategy is the buy in spot. So buy in spot market and take short position. Take short position in derivative. That is the common strategy what we follow. If you are acting like a hedger, if you're acting like a hedger, so this is the common strategy what you follow. What you can do, you can sell in spot market, and you can take long position in derivative. So how this is possible, sir? So how can I sell in the spot market? So that possibility is there, but that you can do only for one day. That you cannot extend beyond a day. That is called short selling. So that is called as short selling. Short selling basically means when you sell first and buy later on. So that normally we do whenever the market is in pessimistic mode. So when the market is going falling down only, when you know that because of what happened in US market and what is happening in Chinese or Japanese market or Singapore market, you know that our market also today will fall down. So because you know that our market will also fall down today, so what you can do, instead of buying, because when the market is in downside mode, so it's not at all logic to buy in the beginning. You can buy maybe later moment of the time when the market fall down very much. So what you can do, you can start booking profit by start in the market. So you can start selling in the market gradually, and then you will buy in the future. So when the market fall down at very low level, so that you can do for a 1 day basis, and that is called as short selling. Okay, so you sell first and buy later on. Fine. So that you can do for hedging purpose. Just an example for your knowledge. So this is the problem. So this problem what you saw, that an investor buys 500 share of SB Limited at 210 rupees. So the value is 1,05,000 and the cash market. Then in order to hedge, he sell 300 future. What is the value for this? 195 threes are. So 195 threes are 15, 1 carry, 27, 28, 2 carry, 585. This is 58500. 58500, 58,500. Okay, this is his value. So next day the share price and future price both will decline. So understand one thing. You bought at 210 rupees. So if the price will fall down, you get a loss. Okay, and if the price will fall down, you get a loss in spot market and profit in the derivative market. I hope you're understanding. So next day it is telling you that next day price fall down by the 5%. So 5%, if it price fall down, then you get a loss. So what is the loss? So loss on 5% all in stock price. So you can calculate the loss. So loss, what is that loss? So 210, it fall down by 5%. 5% of 210 is how much? 10% is 21. 5% is 10.5. So 10.5 is the price. So loss, what is the loss you got? So 5% is 10.5. So 10.5 rupees loss you'll get on one share, and he has bought total 500 share. So you can calculate this. So this is 1055 is 525. So 5250. 5250 and 10.510. So 5250. This is the loss. This much 5250 rupees loss he will get. He will get this much rupees loss. So 10.5 into 500. So he'll get 5250 rupees loss, while the profit while the profit while the profit on 3% fall in short position. So whenever you take short position, You take short position with an intention that the price should fall down. So 5%, 3%. So you did at 195. What is 3% of 195? So 1% of 195 is 1.95, and 3% would be 5.85. So 5.85 into how many shares? 300 shares. This is the loss you're getting. So the profit what you get for this is the profit what you get for this is 1755. So what is the overall profit and loss? So overall profit and loss, if you want to calculate, so you can calculate this. So this the for 5255 minus 1755, 5250, so you get a loss of 3495 rupees. This is your overall profit and loss. Clear, everyone? Anyone have any doubt? Anyone, any doubt? So, okay, guys, we'll do one thing. We'll take 10-minute break. Okay, and so at 1 o'clock we'll start again. So let's have 10-minute break. So we'll start at 1 o'clock. Is everyone understood? No, let's have 10-minute break. So we'll meet at 1 o'clock. Okay. So guys, let's start the class again. So basically, till now you have understood derivatives, and in derivatives, you have understood about what is forward contract, what is future contract. So either I talk about future contract or either I talked about forward contract. So both payoff diagram, if you see, so either you take long position or either you take short position, you have the possibility of getting unlimited profit and unlimited loss, because whenever we talk about future contract or whenever we talked about forward contract, we have the obligation to follow in the future. So because we have an obligation to follow in the future, so that's why in the case of future contract or in the case of forward contract, we always get a linear payoff diagram. So payoff diagram is very important to understand the profit and loss in derivative market. So whenever we talk about calculation of profit and loss in the case of derivative instruments, so we explain the profit and loss of a derivative instrument by using payoff diagram. Okay, so either you talk about forward contract or you talk about future contract. So if you take long position, if I talk about payoff diagram, if I talk about a payoff diagram of a long position holder, so if I talk about a payoff diagram of a long position holder, so if I talk about a payoff diagram of a long position holder, so the payoff diagram of a long position holder is always like this. So here you need to understand that above this horizontal line is your profit, and below this horizontal line we talk about losses. And the next thing what we are talking about here is that the price is always increasing from left to right direction. So the underlying asset price is always increasing from left to right hand side direction. So this is the payoff diagram of a long position holder. So where there's a possibility of unlimited profit, there's a possibility of unlimited profit, or there's a possibility of unlimited loss, or there's a possibility of unlimited loss, or there's a possibility of unlimited loss. So this is the payoff diagram of a long position holder. Similarly, if I talk about a payoff diagram of a short position holder, similarly, if I talk about a payoff diagram of a short position holder, so it doesn't matter that short position holder take short position in forward contract, or this short position holder take payoff diagram take this short position in future contract. So you need to understand one thing. So only thing which differentiate a forward contract and future contract is that the future contract is something which is trading over the exchange, and forward contract is a OTC bilateral agreement. But more or less the logic remain the same, that either you take long position or you take short position, you have the obligation to follow the contract in the future. So if you talk about the payoff diagram of a short position holder, if you talk about the payoff diagram of a short position holder, so this is the payoff diagram of a short position holder. Here, above this line is your profit. Above the horizontal line is your profit. Above your horizontal line is your profit, and below your horizontal line is your loss. And here we always believe that the price or rate anything is always increasing from left to right hand side. Okay, so you need to understand. So whenever you talk a short position holder, so more the price will go down, more the profit booking can be done. So there's a possibility of unlimited profit. So there's a possibility of unlimited profit. There's a possibility of unlimited profit and the possibility of unlimited loss. There's a possibility of unlimited profit and there's a possibility of unlimited loss. So it doesn't matter. You talk about future contract, you talk about forward contract. So remember that their payoff diagram is always they always have a linear payoff diagram. Always understand they always have a linear. So whenever we talk about the payoff diagram, the payoff diagram is a linear payoff diagram, and in linear payoff diagram they have the possibility of profit or the possibility of loss is unlimited. I hope this part is clear with everyone. So this part you can keep in your mind whenever we talk about future contract or whenever we talk about forward contract. Now, going forward, other thing you need to understand that whenever we talk about derivatives, whenever we talk about derivatives, as you can, uh, other thing you need to understand that whenever we talk about a derivative instrument, you need to understand that instruments they follow continuous compounding. So other thing you need to understand that whenever we talk about derivative instrument, so the derivative instrument follow continuous compounding. So the formula for the continuous compounding is future value is equal to present value into e to the power rt. So remember this. So whenever you talk about derivative instruments, they follow continuous compounding, where the formula for that is future value is equal to present value into e to the power rt, where e stands for Euler number, where e is the Euler number. E is the Euler number. It is a irrational constant. It is an irrational constant. It has a value called 2.71828 like that. So this, I can search, I can see the value in Excel. I can see the value in Excel. Imagine, I'll just show you its value in Excel. So if I say in MS Excel, we normally represent E with EXP size. EXP, and if you write 1, so you can see 2.71828. So that goes, so you can see this is the irrational number. So it is a irrational number. So it this gives the value of E. This gives the value of E. So either you can memorize this value, either you can memorize this value, or in simply you write E. E or E. E we write normally in calculators, or you can remember as a EXP. In scientific calculator, if you press shift, if you press shift, if you press shift, then ln. In scientific calculator, you have shift and then ln, you will get E. Okay, so it's the inverse of logarithmic E. So log, when we represent log, we normally study log either as base 10 or either as base E. So inverse of that, inverse of natural logarithm is basically E. So there's a mathematician called Leonhard Euler who first of all came up with this constant. So he found out a strange relationship, that he found a strange constant, that limit of x tends to infinity 1 plus 1 by x to the power x. So if you find this value, that always gives you a constant. That constant what you got is around 2.71828, and that we called as a E. Okay. So tell me one thing, scientific calculator, is that allowed in your exam? Scientific calculator, is this allowed in your exam? Nandita, Ranjit, sorry, Shilpa, Ranjit, can you tell me? a scientific calculator, is it allowed for you in exam? Yes or no? Kindly tell me. So without scientific calculator, how will you do the calculation? I'll tell you. Are you people listening to me? See this question, question number 6. This came in which year? This came in the year 2018. You can see this question number 6. So consider a 3 month maturity forward contract on non-dividend paying stock. Okay, so the stock is available for 200 rupees with compounded continuously risk-free rate of interest at 8% per annum. What is the price of the future contract? So we'll solve this question. So normally when we are solving the problems on derivatives, and if we are trying to find the future value based upon the present condition, we follow continuous compounding. So the you can see the present price of stock. So if you understand this, so the same thing you can use in derivative market, and I can write a formula called, instead of future value I say f means the future price, present value is the spot price, e to the power rt. This is called cost of carry model. This is called cost of carry model, what we can use in derivatives and basically in future contract for the valuation of the future price of an contract. So here they are asking you to determine the future price. Here the S naught is given to you. The spot price of an underlying asset is given to you 200 rupees. So that is given to you 200 rupees. This, okay. So it is a non-dividend paying stock. It is non-dividend paying stock. This is non-dividend paying stock. Okay. Then E, you know E. Then R is given to you. R is given to you. The value of R is 8% per annum. The value of R is 8% per annum. And the time is given to you. The time is given to you as 3 months. So the time is given to you as 3 months. So 3 months, if I convert into year, that would be 3 by 12 year or 1 by 4 year, or that is equal to 0.25 year. So I can determine the future price. So F is equal to 200 into e to the power r. R is 0.088% into 1 by 4. 1 by 4 or 0.25. So I can write F is equal to 200 into e to the power 0.02. So e to the power 0.02. This is the, now how to do this? So e to the power 0.02. So you can do in Excel. So this is exp e to the power 0.02 into 200. That is 204.0402. That is equal to 2.204. That is equal to 204.0402. This is the value what you will get. This is the value. This is the future value, future price value for the non-dividend paying stock. Any doubt, anyone? Anyone, any doubt? Fine. So this is the price of the future contract, non-dividend paying future contract. In exam, they should give you this value. In exam, in the question paper, they should give you this value, e to the power 0.02 value, e to the power 0.02. What is the value of e to the power 0.02? So e to the power 0.02, that is 1.0204. So they should give you this value. They should give you this value, e to the power 0.02. This should be written like this. That is 1.0202. 1.0202. They should give you this value. They should give you this value in exam. If scientific calculator is not allowed, uh, now imagine here. But now you can ask me, sir. Okay, fine, they should give this value, but in like imagine here, if scientific calculator is not allowed, so if scientific calculator is not allowed and this value is also not given, then what we can do, so for there can be other colleges where scientific calculator is not allowed. So by using normal calculator, if I tell you, so by using normal calculator, how you can find this value? So by using normal calculator, by using normal calculator, how can I find the value how can I find the value of how can I find the value of e to the power 0.02? Okay, so guys, one thing you can remember, one thing, you know that try to memorize the value of e is nothing but e means 2.71828. Do this, at least memorize this. Remaining thing I can teach you. So E is nothing but that is 2.71828. Try to memorize this value for the E. Then I'll tell you you can find. How to find this. So I'll tell you this. So by using normal calculator, how you can find this. So what you do, what you do, write 2.71828 uh, in calculator, right? I'm talking in normal calculator how you can do. So write 2.71828 in calculator. So write 2.71828 in calculator. Okay, then what you do, I'm telling you how you can do this. So how you can do this exponential calculation normal calculator, I'm telling you the steps. So write 2.71828 in calculator. Then what you do, then press square root sign. In normal calculator you have square root sign, so press square root sign 12 times. Okay, press square root sign 12 times. So write 2.71828. So you take normal calculator, write 2.71828, and then start pressing square root sign 12 times. Start pressing square root sign 12 times. Okay. After that, what you do? After that, what you do? Then so after that, then do minus one. So then do minus one. Okay, and then press equal to sign. Okay, this is the third step. Okay, then fourth step what you do, then fourth step what you do, multiply this with your power. What is your power? 0.02. Then multiply this, whatever answer you get, multiply this with your power, multiply that with your power, that is 0.02. Okay, and then press equal to sign. Okay, and then after that what you do, then do plus one. After that what you do, so after that do plus one equal to, this is the fifth step. After that do plus one equal to. Once you're done with plus one equal to, then what you do, then press uh, equal to, then press into, and then equal to, into 12 times. Do this, into equal to 12 times. If you do this, then you get the answer. After this, on seventh step, you'll get the answer. You'll get your answer. So you'll get your answer. So if you do this, you'll get the answer. Answer you'll get is 204 point, so not sorry, you got 1.0202. So now in 7th step, you got the answer 1.0202. So once you get 1.0202, multiply that with 200, and that is your answer. Fine. So with normal calculator, how can I find this value? E to the power 0.02. It is logically in exam they should give me this value, but in case if the examiner does not give this value to me, then what should I do? Then where will I run away? And simply for that reason, how should I lose my marks? So how to find this value? How should I find this value? So first write 2.71828 in normal calculator. After that, press square root sign 12 times. So first write 2.718 to it, then square root sign 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. After that, minus 1 equal to. Okay, after that, into 2 into 0.02 equal to, then plus 1 equal to, and then press equal into, then press into equal to sign 12 times. If you do this, you will get the answer. That answer, that is 1.0202. So remember this step. With this, you can perform any calculation. With this, you can perform any calculation in normal calculator without using scientific calculator. So you don't need scientific calculator in normal calculator. By using normal calculator, if you want some calculation, remember these steps. So remember these steps. So if you want in normal, by using normal calculator, if you want the value of x to the power n, so how will I find the value of x to the power n? Again, I'm telling you. So write first x, write x, write x. Okay, then square root sign 12 times. Square root sign 12 times. 5, 6, 7, 8, 9, 10, 11, 12. Write square root sign 12 times. Okay, then minus 1 equal to. Okay, then into power, whatever is your power. Then plus 1 equal to. Okay, then into n equal to, then plus 1 equal to, and then into equal to, not comma. So means comma means into equal to, into equal to, into equal to, into equal to, into equal to. Do it 12 times. Do it 12 times. If you do this, you'll get the answer. Fine. So remember these steps. Okay, so now I hope you understood this. Anyone have any doubt? Anything you want to ask anyone? If scientific calculus is not allowed, this is the way how you can do exponential calculation by using normal calculator. Remember these steps. So in derivatives, when we talk about derivatives, understand derivatives follow continuous compounding. Understand that when we talk about derivatives, derivatives follow continuous compounding. Basically, it derives from compound interest only. So if you remember compound interest formula, that future value is equal to present value into 1 plus r by 100 to the power t. This is a formula of compound interest. You can write this formula as future value is equal to present value into 1 plus r percent to the power t. This is the formula of compound interest. Everyone knows this. This is the formula of compound interest. So in this formula of compound interest, if you know basic maths, you know about compound interest concept and all. So if you know basic maths and you know about compound interest, so you know that if I talk about the situation, that if the rate of interest, if the rate of interest changes per second, the rate of changes per second, because here we in derivatives we believe that they are very volatile in nature, so they follow exponential momentum. So because in the case of derivative, we believe that they follow exponential momentum. So here we believe that the rate of interest it changes per second. So then the formula become future value is equal to present value into 1 plus r percent divided by 365 into 24 into 3600, because 1 year have 365 days, 1 day have 24 hour, and 1 hour have 3600 second. So ultimately this calculation will become like this calculation has become like this. So your future value is equal to present value into 1 plus r percent divided by 365 into 24 into 3600 to the power 365 into 24 into 3600. So this is as good as PV into e to the power RT. So both mean same thing. So the law, just this is a relationship you need to understand, and this is what we called as the continuous compounding. So in derivatives, we do all our calculation based on continuous compounding. Okay, so understand this. So if you have done aptitude, quantitative aptitude, I have taught you at the beginning of your first semester exam. So there I taught you the subject called simple interest, compound interest. I told you amount is equal to principal plus interest. Principal is the money what you deposit for your investment. R is the return what you get on your investment. T is the time period. So different bodies calculate interest differently. So like some bodies like NSC, National Savings Certificate, or Kisan Vikas Patra, they calculate interest 2 times in a year. So the rate of change of interest is compounded half yearly in them. Okay, so if the rate of interest it changes half yearly, if the rate of if the rate of interest if the rate of interest is compounded half yearly, if the rate of interest if that is compounded half yearly, the rate of interest that is compounded half yearly, so then the formula becomes future value is equal to present value into 1 plus r percent divided by 2 to the power 2t. If the rate of interest if that compounded quarterly, then your formula becomes future value is equal to present value into 1 plus r percent divided by 4 to the power 40. Okay, so you understand now, like in India the bank calculate interest every day. So if the rate of interest if it calculated every day, so then your formula will become future value is equal to present value into 1 plus r percent divided by 365 to the power 365. So this is the logic on which we do our calculation. So the same logic we use for derivative instruments. So in the case of derivative instrument, we believe that the rate of change happens every second. Because the rate of change happens every second, so ultimately you can do this calculation instead of doing such a complicated calculation like this way. This is as good as present value into e to the power RT, and both gives you the same value. Okay, so here also if you want to see 365 into 24 into 3600, so you got this value, this is suppose m, suppose this is your m. Okay, this is your m. So if you want to do this calculation what you got, okay, this calculation what you got, if you want you can do the same thing here. So future value is equal to present value, that is 200 into 1 1 plus what is your r, is your, how much is your r, 8%, r is your 8%, 8% divide by this m, to the power t. T is how much? T is how much? 3 months, means 0.25 into this constant. So you can do this calculation. So you can see the same answer. Can you see that? So can you see the same answer you got? So instead of doing such a complicated calculation, you can do the same calculation like this. So always remember that when we talk about derivatives they follow continuous compounding. Okay, so remember that thing in your mind. The same logic we use also whenever we talk about the valuation of future contract and all. So whenever I talk about valuation of future contract, whenever I talk about valuation of future contract. So we study the same thing under something called cost of carry model. So under cost of carry model, we study the same thing. So under cost of carry model, for non-dividend paying stock, if I want to calculate the future price for non-dividend paying stock, for non-dividend paying stock, if I calculate the future price, so the formula for the future price is F is equal to S naught e to the power RT. This is the formula. So understand dividend is like a income. So S naught is the, see, understand S naught is the cost. So spot price. So what if you buy the stock right now? So the price what you need to pay is the S naught. If you buy the stock right now, the price what you need to pay is S naught. But you're not buying right now, you will buy sometime in the future. That is the concept of derivative. So definitely you need to pay additional cost of carry. That's why that is called cost of carry. Means carrying that for certain time period, storage cost and other things. So that is what we are calculating. By using this formula, what we are actually calculating, we are actually calculating the cost. So if you're actually calculating the cost, so in that, dividend is like an income for you. So if you get a dividend, if you are getting a dividend, that is like an income for you. So that will reduce your cost. Okay. So that's why you need to understand. Similarly, for dividend paying stock, so for dividend paying stock, suppose if a stock pays you dividend, so if a stock pays you dividend, and suppose total total value of the contract, total time of contract, not the value. Suppose the total time of contract is T1. Suppose the total time of contract is T1, and dividend is paid. Uh, what should I say? 3 month and dividend paid after 45 days. Suppose dividend is paid after T2 days. Dividend is paid after, and dividend is paid after T2 days. Okay, something like that. So what is the future price? That is S naught e to the power RT1. Okay, minus what you can do, dividend D e to the power R, and then T2 minus T1. That, so dividend is paid after, if suppose 3 month is the contract, and you get the dividend after 1 month. That means the dividend will grow for 2 months. So means I can write T1 minus T2. T1 minus T2. You can use this formula for dividend paying stock, or you can write F is equal to S naught minus dividend. If it paid after 1 month, I'll let determine the present value. The present value of that is e to the power minus R. So if I'm determining present value, so minus, so R T2, and then this is e to the power RT1. You can use any formula for that. Fine. So to determine the whenever this dividend is there, you can use this for the dividend paying stock to determine the future value. So okay. Uh, See guys, understand. So if whenever you use cost of carry model, so your future value is equal to present value into e to the power RT. So present value I can determine as future value into e to the power minus RT. Both mean same thing. So, so you understand, for if the stock is dividend, then this is the formula what you follow to calculate the future price for the dividend paying stock. So for non-dividend paying stock, this would be the formula. For non-dividend paying stock, this would be the formula. For dividend paying stock, this would be your formula. Fine. And similarly, if you go further, and if you talk about uh, if I talk about stock with dividend yield, if I talk about stock with dividend yield, so if the stock with dividend yield, what is dividend yield? So when I say, so this formula is S naught e to the power R minus Y into T. So what is dividend yield? So dividend yield basically means, I believe everyone knows this term called yield. Yield basically means return. So yield basically means return. So dividend yield, what is dividend yield? So you can type in Google the formula for dividend yield. So for dividend yield, we use many formula like what is the total dividend what is paid by the company in last 1 year divide by the current market price of the stock into 100, or you can use a total dividend paid by the company in last 1 year divide by the average market price of the stock for the last 1 year into 100. Anything you can use. Dividend yield basically means return what you can get in the form of dividend. So whenever you do investment in the stock market, you get return. You can expect return in two ways. Either you get the return in the form of dividend, or you get the return in the form of capital appreciation. That is the only two ways you can get return from the stock whenever you do investment in the case of stock market. Okay, so basically, dividend yield basically means those investors who specifically invest in those stocks which offers them lot of dividend. So dividend is the part of the profit what the company gives to the shareholder as the reward of being associated with the company. So that is called as dividend. So basically the profit after tax of a company, I can break it into two parts. It can be dividend plus retained earning. So the part of earning what the company does not give to the shareholder, which they retain with themselves, is called retained earning, which they accumulate with themselves in the form of reserve and surplus. So whenever you have a stock with dividend yield, you can use this formula, that is F is equal to S naught e to the power R minus Y into T. So you can study this. Okay, and going further, like in the case of currency market and all, so like if when you study IFM, so in IFM when you're studying IFM, you use the formula that future contract on currency future. So currency future contract on currency. So when you talk about currency, so then you use the formula F is equal to S naught e to the power RH minus RF into T. So you know that currency always trade in pairs, and whenever you talk about currency, you need to talk about both the two factors, like what is the interest rate of home country and what is the interest rate of foreign country. I believe you know about direct quote, indirect quote, and all. So interest when you talk about currency, so the currency movement depend currency always trade in pairs, and its movement depends upon the interest rate of home country, also on the interest rate of foreign country. So this is the formula what we follow whenever we talk about the future contract on currency. This is the formula. So remember this formula. Similarly, when I talk about commodity derivative, so if I talk about commodity derivative, so commodity future contract. So if I talk about commodity future contract, so the formula what we follow, that F is equal to S naught plus U e to the power RT. Okay, this is the formula what we follow for commodity future contract, where U is called as storage cost. Where U is called as the storage cost. 1 minute. So you need to understand one thing, that whenever I talk about derivatives I can trade on. Whenever I talk about derivatives, I can take positions on derivatives either in financial market. So I can have financial derivative, I can have currency derivative, I can have commodity derivative, I can have interest rate derivative. So more or less you know about whenever you are using the concept of derivative in the real market based upon the underlying asset. You can have financial derivative, commodity derivative, currency derivative, interest rate derivative, okay, credit derivative. So if I'm talking about a financial derivative or currency derivatives, so basically they always have a cash settlement. Okay, so remember that in India, I'm talking about in India, for financial derivative and for currency derivative, we have cash settlement features. Okay, but in the case of commodity derivative in India, so if a seller and buyer at the beginning of contract, they can either tell they are looking for physical settlement or they are looking for cash settlement. If you say you're looking for physical settlement, your initial margin amount would be very high, while if you talk about cash settlement, your initial margin amount would be less. So what happens in the case of commodity derivative? Whenever a seller want to take positions on future contract in which the seller want to do physical delivery in the future, so what the seller need to do? The seller has to deposit the commodity on which he want to take future contract with the exchange. So because whatever is being specified by the seller at the beginning of the contract under the future contract, the same thing should be maintained at the end of the time period. So what the seller need to do? Seller has to deposit Seller has to deposit the underlying asset with the exchange. So what exchange basically do? Exchange have a warehouses. So seller, when you deposit the underlying asset with the exchange, so exchange keep that asset in their warehouses, and the seller has to pay money for storing their asset, the underlying asset in the warehouse. That cost is called a storage cost. So the storage cost is the sum of fixed cost plus variable cost. Fixed cost means, like, suppose you want to store gold, so there may be a locker for the gold. So that is a fixed cost for that. So it doesn't matter you store gold for 1 day or 1 month or 3 year, that fixed cost remain the same. Plus variable cost, which depends upon the total time period for which you're storing that asset. So that fixed asset there. So that is a variable cost what you need to pay there. The sum total of that is called storage cost. So that storage cost is the additional cost what you get in the case of commodity. So that's why the formula has become F S naught plus U, because till now when you talk about financial derivative or currency derivative, we are talking about intangible asset. But in the case of commodity derivative, we are talking about a tangible asset. That's why the formula become S naught plus U e to the power R. Okay, so I hope you understood this. Now, so whenever there's a term which you should know. There's a term which you should know. That term is called convenience yield. There's a term what is called as convenience yield. So if you are someone who are looking for physical delivery of an asset, then you if you are someone who is looking for physical delivery of an asset, then you need to pay storage cost. But along with storage cost, there's a additional benefit what you get, because you are taking you are actually doing transaction on the physical asset. That additional advantage what you get, that is called as convenience yield. Because understand one thing. I'll try to help you with an example. I'll try to teach you with an example. Suppose I'm interested in gold. Okay, suppose I'm interested in gold, and so if I'm interested in gold, so what I can do, I can either trade on physical gold, or either I can trade on electronic gold, e-gold, or ETF. Gold ETF is there. So if you are only looking for investment purpose, so the physical delivery is not something you are interested about. So what you are interested only about the electronic, you are only looking, because for you the gold is like a mode of investment. So the price of the you buy at this price, tomorrow the price will increase, so difference will be your profit. So you're nowhere looking to use gold for any other purpose. So you are just looking gold for the investment purpose, and then you can either take position on e-gold or gold ETF, and then your work will be done. But understand one thing, instead of that, if you take physical gold, if you trade on physical gold, although you need to pay some extra cost in the form of storage cost, but understand, tomorrow if you are having a physical gold or if you are having electronic gold, so the advantage what you are having with a physical gold is that you can use that for other commercial purpose also. For you understanding. So if you are just having electronic form or dematerialized form, that can be only used for investment purpose. But if you have physical asset with you, so maybe you melt that gold, you can create some alloy, or you can use this for industrial purpose or commercial purpose, or you can put under Sona Chandi Chawan Pras. you can do anything with that gold. You can use it for medicinal purpose, anything you can use for metallurgy, you can use for mining, whatever. So the additional advantage what in commodity gives you, if you have a physical, if you have the physical asset with you, so that advantage is called as convenience yield. So many times we do the adjustment of convenience yield. Suppose convenience yield here is y, so I can write the same formula, f is equal to s naught plus u e to the power r minus y into t. So to do the adjustment of convenience yield. Okay, so it's all depends. So if I talk everything as not e to the power, so r plus u minus y into t. So if I talk everything in the term of percentage, suppose storage cost is also written in percentage, convenience yield is also written in percentage, r is your cost of financing, r is your cost of financing. So then you can use that, you can use this as a formula. So it all depends. So what is R? R is your cost of financing, because we believe that you do this transaction by borrowing money from the market. So there is a cost what you need to pay. So this is about the cost of carry model. So please make sure that you have a basic knowledge about cost of carry model. That is very important. Even when we talk about options also, that time the implication of cost of carry model plays very significant role. So guys, this is for me from this class. So it's time for me to sign off from the class. I hope you enjoyed this class, and I'll meet you very soon tomorrow for continuation of discussion on future content. So guys, please don't forget to click on the like button and subscribe to my channel if you're not subscribed. So guys, I believe you don't have any doubts. If you have any doubt, please use the comment option and post your doubts in the comment option. So with that intention, it's time to say goodbye to all of you. Thank you everyone. See you everyone tomorrow for the next class. Thank you. Bye. Any doubt? Rajit, Silpa, any question you want to ask?